But it's the last quarter of the financial year, which means that taxpayers must get into tax management, tax planning and tax saving mode. One great method to do so is by investing in ELSS. If you invest in equity linked savings schemes, which is a kind of a mutual fund, you will get a tax break of as much as 1,50,000 rupees in a year. This is of course provided that you stay invested in the ELSS for a period of at least 3 years. Now usually from December onwards we start seeing investors put in money in ELSS schemes, and hence we should see net inflows come in ELSS. But interestingly, as we see this net outflow mode continue for mutual funds, even ELSS schemes are seeing net outflows. But nevertheless, we will be talking about this fund, and that's the reason why this category rather, and that's the reason why in our Meet Your Fund Manager segment we decided to address and talk about this category, the ELSS scheme. We are bringing on board Rohit Singhania, who is the fund manager for the DSP Tax Saver Fund. Rohit, thank you so much for joining us today on ET Now. So yes, I have given sort of a brief description of ELSS, but tell us where and how does an ELSS score over other tax saving investment options out there?
I think when you look at the option of ELSS investments under the tax saver scheme, I think there are a couple of benefits, I would say, compared to others. One is the lock-in period of 3 years. I think it's the minimum of the various options available. Secondly, after 3 years, you're taxed at a 10% long-term capital gains. So the idea is, as an investor, as an salaried class, as you move up the ladder, move up your years, the income goes up, your tax level eventually goes up. So here's the option you get, being taxed at long-term capital gains. Secondly, here you also have an option, to have a systematic investment plan. Like in equities, we tell investors, instead of lump sum, you have a monthly SIP or a fortnightly SIP. So ELSS also, the fear is, we always get a lot of inflows in the last 3 months of financial year. So your investor or an individual has an option to invest throughout the year and not to worry about market variances. I think these are the few, benefits a ELSS scheme has over the other options available under Section 80C.
However, what's interesting, Rohit, and this is something that we've not seen at least for the last 8 to 9 years, there have been consistent outflows from ELSS schemes, and even in the month of December, this is the first time in December in almost 8 or 9 years that we are seeing an outflow from an ELSS scheme. Usually post-December and in this last quarter of the fiscal year, we start seeing taxpayers putting money in ELSS, but this hasn't happened. So what's the reason for the outflows according to you?
So I would not put only on the ELSS part of it. I think the entire market, the domestic industry has seen a decent amount of outflows. Do I have actual reason for it? I mean, it would be difficult to hazard a guess. But as you see, what happened in last calendar year, from Jan to March, the kind of fall which we saw, and then the pickup towards the end of the year. So here it could be, a kind of sentiments also. You saw your NAV down 25-30%. You're back in the money. So, as in security, why don't you take some money out, keep it with you? That could be one reason. For the last few months, data flows have really picked up for real estate sales, right? Housing sales. So it could be, people who are waiting to buy houses in last so many years, they have begun to do that. Few of the financials, banks, which have come out with their preliminary data for the December quarter, they have seen increase in CASA ratios for them. So I think it's an influence of all that. You're seeing a big negative to your NAV, then a pickup. You have other investment opportunities. So I would say it's a mix of all these 2 or 3 factors that I just mentioned. And typically, the flows in this kind of category picks up in the month of February, March. So I would not be really worried about looking at the data which has come out for the month of November, December at this point of time.
All right, fair enough. Rohit, now, let's focus in primarily on the DSP Tax Saver Fund. If you could just talk to us a bit about the fund, where does it invest? What's the split, between different market capitalizations?
So the DSP Tax Saver Fund is, today as we see, it's about 68% into large cap stocks, about 19% into mid cap, and about 11.5% into small cap stocks. That's the split. Historically, if you see the fund, it's had a slightly higher tilt towards large cap. So over the last 5 years, if I see, the minimum weight in large cap has been 65%. In terms of construct of the fund, so though when we get money, fresh inflows, it's a 3-year closed-ended money. But a significant part of the AUM is still, more than 3 years old, which is maybe open for redemption from investors. So I really don't run the entire fund as in pure 300 closed-ended fund. It's run as a diversified open-ended fund. The stock selection is, a combination of a bottom-up and top-down in cases of cyclical sectors, as we see. As the fund stands today, we are overweight on financials, materials, telecom, and healthcare. And the fund has a significant underweight in consumer staples per se. What we believe in is, and the theory has been, at what price are you buying these companies? What kind of margin of safety are you looking at it if you take the next 2 years expectations? So that's what goes into in terms of select. It's like a flexi cap fund. We don't have any restrictions on the kind of weight we need to have across segments and sectors.
Rohit, I would like to ask you about how you ensure the quality of the stocks that enter the fund. The reason why I ask you this is because we have unfortunately seen instances in the past where, downgrades for a particular stock or the failure of, a particular company that it does exist in a mutual fund tends to drag the NAV down. More so, of course, for a debt fund, but it has impacted the NAV of various equity funds as well. So how do you ensure the quality of the stocks that enter the fund, the filters that you have in place?
So the basic checks, Adesh, when we look at the fund is, the ROEs, cash flows, and ROCE, and more importantly, the sustainability of these things. Also, every sector, every businesses cannot be looked at the same lens. You have some sectors maybe going into a cyclical upturn or downturn. At that point of time, you need to analyze, okay, what's going right or wrong for the industry? What is the ability of the company to come back? So I would say, yes, ROE, cash flows, ROCs are important, but you need to have a different lens. For example, today, our industry may be having a net working capital days of, say, less than 50 days, whereas some cyclical industries have working capital of more than 100 days. So is the quality good or bad? It's not a right way to predict. So again, it's within the sector, how companies are spaced in kind of these parameters, these metrics, that's what we look at it.
Well, that's all that you need to know about the DSP Tax Saver Fund. Rohit, thank you so much for joining us today on ET Now and, sort of introducing the fund as well to perhaps some viewers who may not be aware and just breaking it down as well for them. Thank you so much once again.